So I met with a client yesterday. He said, Mark, we're very successful. We make close to 7 figures per year. We're looking to put some money somewhere. We don't want to put it in the market because we don't want to risk losing it. We don't want to put it in real estate because the real estate market's a little out of control right now. And we think there's going to be a correction. And he said, we're also looking for some type of tax advantage. Slightly skeptical in the beginning, not knowing if I could help him or not, he said, Mark, what you got for me? I said, Mr. Client, we got you. Let me tell you a little bit about what we call LIRP, L-I-R-P. That's called Life Insurance Retirement Plan. It's built on the framework of an indexed universal life insurance policy. That's a permanent cash value policy where you can get the highs of the market without any of the losses. I said, Mr. Client, the way that we design these policies are for minimal death benefits so your cash can accumulate as fast as possible with compound interest. Based on his income and his expenses, he can comfortably put away about $200,000 per year. So he decided that he wants to do that for the next 5 years. Once 5 years is over, no more money is going inside that policy, but the money's going to continue to grow from that point on. Now I said, Mr. Client, since you own your own business, we can do something called a executive bonus plan. Executive bonus plan is when a company wants to use the premiums going into that life insurance policy as a bonus to that executive. They get the tax write-off. He's going to be putting in $200,000 for the first 5 years and then stopping. We designed it with a minimum death benefit, maximum cash value strategy. So $3.2 million is going to be his death benefits. At the end of 5 years, he'll have full access to about $1 million in there, which means he can loan against his policy tax-free and use that money that he's accumulating. By the time he's 65 years old, he's going to have $3 million that would have accumulated in his policy. And by the time he's 84, he'll have over $10 million in his cash value. Now, when he passes away, whether that's at 85 or 95, he'll be leaving his family with the remainder. Oh, and by the way, those numbers were only ran at around 5.9% growth. But he has the potential to get whatever the market gives. Now, while there's lots of pros to this type of policy, there are some cons. Number one, it's a life insurance contract, so it is dependent on your health. Number two, while we can design the policy to the best of our ability, you, the client, have to be able to fund the policy properly. And number three, there's a surrender period of this policy at around 10 years. If the client decides to close his account and take his money, he's going to get hit with a penalty. Now, if you're looking to get something like this set up for yourself, regardless if you're making 7 figures, 6 figures, or even less, we can still have the conversation and see if it's a good fit for you. Click the link in my bio.